Hey dividend investors, today's video is about dividend paying US stocks for those who are in Canada, because that's where I live. But anyways, there's multiple different types of accounts that you can have as a trader. The number one most common is a cash and margin account. A cash account is where you can trade stocks. Margin account, same idea, but you have margin to be able to essentially either make more money or not make more money and make less money. I personally would never use margin, but I do have a margin account myself. Then there is a TFSA trading account, which is generally a tax-free account for any income that you make in it. Generally, you would want to put dividend-paying stocks in there. And then there is also the RRSP, Registered Retirement Savings Account. And from there, what you would do is, again, same thing. You would want to hold safe things like a ETF, generally are safe in some cases. And then also safe stocks. Dividend paying stocks are generally referred to as really safe. So a lot of people are holding them in TFSAs, which I do as well. But with USA companies, there's a different kind of atmosphere, I guess you could say, when it comes to taxes on those dividends. And let's just get down to it. Even though you have a TFSA, and you say, well, I want to make all of my dividend income in a TFSA. And that seems like a very smart thing to do. That's not always the case. So with US companies that are on the US market, and you'd be obviously holding it in US money, there is a withholding tax when it comes to the dividends. So inside of a TFSA, you're basically sheltered from taxes in Canada. You're not, however, sheltered from tax on American stocks. So if you're holding, for example, Apple and it's paying, let's just say for the sake of argument, it's paying 1%. And let's say you hold $100 worth of stock, which you'll hold more than that because the stock's worth more than $100 for even one share. But let's just say you are now making 1% on $100. Well, now, from there, you're going to be getting $1 of dividend income, $1 US. Then you would think, well, that's pretty good. I like that. But there's a withholding tax. And on a US dividend, there is a 15% withholding tax, which means that dollar that you expected to get, it's actually only going to be 85 cents. And now, of course, if you had $1,000, it would be $8.50. And if you had $10,000 of stocks, it'd be $85 instead of $100 that you would expect to be able to make from that dividend. Why is this important? Well, we all thought that TFSAs were tax-free, but that's not the case. Let's really break this down. So inside of a TFSA, you get that dividend, it's only going to be $85. If you hold, however, the Apple stock in a margin or cash account, you're still only going to get $85, but that $15 that you missed out on is actually going to be a tax deductible, and you can basically get some of it back from the government at tax season from the Canadian government, but it pretty much is a whitewash, and you'll just eventually get back your $15, and that's all it is. But that does go against your income as well, and when that happens, you'll be still paying taxes on the 85, and it's just complicated. But there's actually a treaty between the United States and Canada where if you hold that Apple stock, for example, that American dividend-paying stock, in your RRSP, guess what? That is now not going to happen. You are going to get that full $100 that you thought that you were going to get, and it is now in your account. There's no withholding tax on US paying dividend stocks in your RRSP. And this is something that a lot of people don't know. There's also the Registered Education Savings Plan and the RRSP that also is lumped in together with the TFSA, where you would still have to pay that withholding tax. And at that point, you're not going to be getting that $15 back. So how I recommend holding US paying or dividend paying stocks is to not hold US paying dividend stocks in your TFSA or in your RRSP. I would say hold it at the very minimum in your margin or cash account, and then at the very best, hold it in your RRSP, because then, of course, you're still taxed on it, technically speaking, when it comes out of the account, because then you're taxed at whatever your personal income tax rate is at the time. But at least at the time of making that money, it's not taxed. It's not taxed by the Americans. It's not taxed by the Canadians. Until you take it out of that account, then it's taxed by the Canadians at whatever your tax rate is. Anyways, I hope that this video has kind of given you an idea of how to invest. And if it has, hit that like button and subscribe. And I'll talk to you guys again in my next video.